My name is Joshua Lim. I head derivatives trading for Genesis Global Trading, which is a full-service broker-dealer involved in crypto. We provide kind of boutique financial services to everyone from crypto-native hedge funds to more established institutional firms, banks, in getting access into crypto, in structuring more bespoke deals, lending, borrowing, spot trading, kind of the entire gamut. So I started at Genesis Trading about a year and a half ago. There was a need in the market for a service provider that could really interact in a more complex way with counterparties. There was a lot of demand for hedging instruments, for a way to express very nuanced views in crypto trading. And really the right way to do that is to use derivatives, puts and calls and forwards. And so there was definitely a market need. The market itself was starting to mature and become much more liquid. And at that time, Genesis had such a great platform, a great franchise of counterparties, both as a result of its positioning as a OTC dealing desk in spot, as a result of its lending business, Genesis Capital, which is one of the largest wholesale lenders in crypto, as well as its relationship with DCG, our parent company, and Grayscale, which is one of our sister companies. Grayscale is a big asset manager. So there's a lot of pieces in there, and it made sense to sort of build a derivative business on top of that. Crypto derivatives are a product set that allows you to take levered views on crypto. So on the directional view price of crypto, you can buy call options to express a long view. You can buy put options to express a short view. A lot of people use these sort of structures to get yield on their positions. So if you have a long position on Bitcoin, for instance, you could sell a call option, which limits your ability to get upside exposure. You're selling off the exposure that you have on Bitcoin above a certain price point, but in exchange you receive some premium upfront that you can collect yield on. So basically, if you do this systematically over time, it's as if you were sort of generating yield on your holdings. There's other sort of more packaged ways of doing this that people are talking about more and more these days, structured products. You can buy a note or a certificate that gives you some specified payout that says, you have Bitcoin exposure up to 20%, and you have Bitcoin exposure up to minus 20%, and if it goes below, you're protected. You don't have any more loss below that point. And those are very attractive for people who have more conservative risk profiles. I think the most interesting part of the digital asset industry today is how it's evolving to become much more institutional. So if you think about the evolution of crypto from the early days where it was much more retail driven, a lot of retail users were using offshore exchanges to get leverage on crypto. Even today, a lot of that retail demand is still there. Maybe a lot of it's more channeled into DeFi and sort of on-chain protocols. What's happening in the derivative space is that there's much more institutional participation coming in, and you can measure that by the volumes that trade on CME, which is a highly regulated US exchange. You can measure it by the amount of volume trading on exchange-listed products like the Grayscale Trust products, the Canadian ETF products. There's just a lot of ways and sort of new formats for institutional investors to allocate into Bitcoin without having to directly touch the asset. And a lot of those formats involve derivatives in some way. So I think if you look forward sort of 5 years ahead and think about where crypto is going to be, I think it's almost certain that the idea of decentralization and on-chain protocols governing more and more financial transactions is going to be a reality. I think firms like us, which are sort of these financial intermediaries, will have a place, especially for pricing certain types of risk. But I think more and more it'll be much more mainstream for consumers to be using applications like Uniswap, like Compound, to get loans, to exchange assets. I think more and more assets will be wrapped in formats that can be exchanged on-chain. I think that's almost certainly a reality. You'll see more and more service providers, banks, asset managers, build products that are not necessarily easy to categorize between traditional finance products, traditional assets, and crypto. I think everything will have some sort of hybrid element to it. The long-term trend is towards more and more people holding digital assets as a larger percentage of their portfolio, whether it's because those assets themselves are becoming digitized or because as a store of value, it becomes much more of a higher utility for them to hold it versus other existing store of values like gold. What we're seeing more and more is politicians asking us for our input on how to approach this. It's great to see innovation-friendly approaches to regulating it, but if we sort of push too hard or stifle that sort of innovation, you could see a lot of sort of interesting ideas that would normally be US sort of based startups or projects migrate offshore because of the framework.